Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Joyce, managing director on Nasdaq's market intelligence desk, for an update on levels to watch in the Nasdaq-100. And Brian, before we get to your first couple of charts here, let's talk about what we're seeing holistically with the market. It feels as if we have this disconnect with what the market wants, what the Fed is saying it's going to do,
Sure.
And I think that's why we see this tug of war, particularly impacting Nasdaq-100 stocks.
Yeah, so there's been a lot of activity the last couple of days, 3 straight days in a row down, Fed meetings, ECB meetings. And so I think the disconnect that we're seeing now between the marketplace and the Fed, which is kind of the opposite of what we saw in the last year or so, whereas in 2021, the Fed was seemingly late to raise rates to combat inflation. And this year, they're now becoming very aggressive. 4 straight 75 basis point rate hikes until yesterday, where they loaded to 50 basis points, but still more hawkish in their commentary and their projections for next year regarding inflation and where they see the terminal rate going. So right now they're targeting or expecting 5.1% roughly is what the dot plot is suggesting from most committee members, where the terminal rate will top out next year. The market right now, Fed fund futures, is around 4.8, 4.9%. And so on the inflation front, I think their year-end target for 23 is 3.5% core PCE, and the market is expecting inflation to be actually lower than that, 3%.
Yeah, well, Brian, it's so interesting. We have strategists in and out of here all day long, and one consistent theme that I've been hearing is, okay, we know the macro picture is going to be challenging, at least through the first half of 2023, but the other thing is what's happening with earnings. That next shoe to drop, that capitulation moment that they're waiting for, is for it to base out and for analysts to bring their estimates down and to come more in line with what they perceive earnings to look like, particularly as balance sheets are starting to get stressed a bit, right? We're starting to see cash, move away from the balance sheet. So it seems as if that's really going to be like the next catalyst here to kind of get us on this path of basing, to get us to where we want to be in the second half of 2023.
Yeah, it's regarding that. There's two components to with the stock market. Earnings, as you just alluded to, and then the multiple. What's the valuation? And so, as far as the multiple goes, that's really largely a function of interest rates. And I think, based on the Fed targets and what the market is targeting for the terminal rate to be next year, they're really not that far apart. It's less than 25 basis points. But how long will they stay at that upper level, that 5.1% level or 4.9% in that range, is important, and not only to the valuation of the market, but also to stock earnings and corporate earnings. So it's difficult to say to have a forecast of corporate earnings that you're very confident in over the long term, say 9 to 12 months, because it's unclear as to how long the Fed will keep rates at that level. It seems like the market doesn't think it should be as high as the Fed projects it to be, and if the Fed does stay with that higher rate target and rate forecast, like it did say in 2018, where we had a very difficult fourth quarter, then that should have a greater negative impact on corporate earnings. So it's kind of wait and see, what the Fed actually does.
It's almost like this tug of war between the market and the economy, because they are in fact, two very different things at the end of the day. Let's pull up your first chart here. Take a look at fresh levels to watch on the Nasdaq-100. Of course, underperforming the indexes today, sensitive to what's happening with the Fed and, of course, inflation.
Yeah, I think the higher for longer is having a greater negative impact on those growth companies, which tend to be a lot of them in the technology space. And so we've seen, this is a longer-term weekly period chart. We could see that this week's high, it's 17% off the recent lows made back in October, compares to 17% that we saw back in March when that peaked out. It stalled then at the 40-week or 200-day moving average, but it's not as great as what we saw this summer, where it rebounded 24%. But both prior highs stalled right around that 40-week moving average, and that's what we're seeing again this week so far. If we look at the daily period chart, if we zoom in here, we could see that there was a recent price gap that was made in early to mid-November, those red horizontal lines right there. So I think that's the key near-term support level to look at. That's in the 11,000 to 11,235 range. That's a level that the shorter-term investors, if you're bullish and you're constructive, you want to see that level hold as support. And then just going above, even if we get higher than these recent highs made earlier this week, around 12,166, we have that 200-day moving average coming in around that 12,420 level. We haven't really been able to get above that, this entire year on the downtrend. And more importantly, that 200-day moving average is still clearly trending lower. So that's something that is something to be considered.
Anyone you've been talking to on the desks that have any concern around credit?
Not in the near term. We were talking about this offline earlier. The last cycle that we went through, where the market sold off 30-35%. This is around COVID. We didn't really have a credit cycle there in that event. Everything rallied very quickly off the lows, largely because of the fiscal and monetary stimulus. This time we don't have that kind of support seemingly, to look forward to in 2023, 2024. So I think the expectation is we will have a credit cycle this time around. So we are seeing banks build their loan provisions. JP Morgan at the Goldman Conference last week announced that it's going to increase its quarterly provisions, I think double what analysts were expecting. So, that's part of the normal cycle. And so you did see banks underperform last week on expectations that we will have, a credit event coming up next year.
It doesn't feel like 2008, 2009 though. It's not as systemic.
No, I mean, so 28, it's 08, 09 was, the housing crisis.
Right.
From what I hear, from things that I read, I think there's a lot more comfort around housing and even housing credit. Home prices are certainly coming down right now, given how high interest rates have gone up and mortgage rates have gone up. There does tend to be a much longer delay in the impact of higher rates on home prices. But I think the underwriting has been much better this cycle around. I think auto maybe is of greater concern, but on a systemic basis, that loan bucket is much smaller than what we'd say housing would be.
All right. Appreciate the insight as always, Brian. Thanks for joining us on Trade Talks. And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.